Today, we're looking into Kratos Defense and Security Solutions. Now, this is a company really right at the crossroads of a very high-growth technology and the often complex world of government contracting. You see Kratos in headlines talking about the future of warfare, but, well, its current financials might be whispering something else. Perhaps extreme caution.
Exactly. And the central question, it's pretty simple, but honestly crucial for any investor. Is Kratos' current, quite premium stock valuation actually justified by its strategic position and, yes, its technological leadership in next-gen defense? Or are the fundamental financial metrics telling us we're looking at, well, an unsustainable overpricing bubble?
And I'll be arguing that the forward-looking momentum, the clear technological lead, and those accelerating contract wins, they absolutely validate the stock's trajectory.
And I'll argue that while, yes, the tech narrative is compelling, no doubt, the extreme current valuation metrics and, frankly, the severely suppressed profitability create a level of risk that, well, sophisticated investors just can't ignore. We have to look hard at the fundamentals, especially cash flow, not just the potential tech.
So my position, it's really built on the structural change Kratos is driving in the aerospace and defense sector. I believe this stock price reflects an unmatched market position in critical, fast-moving national security areas. And we're not talking about, traditional jets here. We're talking unmanned systems, drones like the Valkyrie, and hypersonics. These are arguably the future backbone of the U.S. military. The market sees this shift, and it's rewarded Kratos 195% return over the past year and an almost unbelievable 597% return over the last 3 years. That isn't just noise, that's market conviction. Financially, the underlying structure, I think, supports this aggressive growth. Sales are at $1.28 billion, with recent year-over-year growth around 14%. But the key, really, is the forward momentum. Expected EPS growth over the next 5 years forecasted at a very aggressive 30.41%. And importantly, their balance sheet provides a strong buffer for this investment. Financial leverage is extremely low. Debt to equity is just 0.07. Liquidity is superb, a current ratio of 4.30. This structural health translates directly into predictable future revenue. And you see that highlighted by the contract backlog jump, went from $683 million to $873 million in just 1 quarter.
But when you strip away some of the, let's call it, market euphoria and the excitement around future warfare, what you're left with are financial metrics that signal pretty profound, quantifiable risk. The current market price, $76.70, it seems massively detached from, well, any traditional intrinsic value calculation. Several models suggest the actual intrinsic value based on current profitability and, let's say, achievable growth rates, it probably ranges between about $19 and maybe $22 per share. Now, that suggests the stock is overvalued right now by well over 70%. And the valuation ratios themselves, they're historic, frankly almost unbelievable for a company with this kind of revenue profile. The trailing price-to-earnings ratio sits at an astonishing 624.59. I mean, just to put that number in perspective, that multiple implies the market is valuing every dollar of current profit as if it expects that dollar to grow perfectly, well, for centuries. Even the forward PE, which looks at next year's admittedly highly optimistic forecasts, is still nearly 100. And when we pivot to operational efficiency, the picture gets quite a bit worse. Return on invested capital, ROIC, is a mere 0.95%. The overall profit margin, a very low 1.56%. And maybe worst of all, the company reported a negative price-to-free cash flow that indicates a serious inability to generate actual cash from its operations, despite the revenue growth you cited.
Complaining about a PE of 624 when the trailing earnings per share is just, $0.12, it kind of misses the entire point of investing in a disruptive defense technology company that's clearly in an intense ramp-up phase. These ratios arguably are largely irrelevant when Kratos is investing so aggressively in market-defining programs. Specifically, we're looking at things like the collaboratively operated aircraft CCAs, these low-cost sort of expendable drones meant to fly with crewed fighters and advanced weapon systems like the Ragnarok missile. These programs are set to define future defense budgets. And the current high valuation, it's pricing in the enormous revenue realization when these platforms move from development into, well, mass production. The low current profitability is, in a sense, a planned consequence of securing that future dominance.
Paying over 600 times current earnings is practically the definition of speculation. Doesn't matter how exciting the technology is. And while yes, I agree high-growth companies command a premium, even their price-to-sales ratio is extreme. It's sitting at over 10 times sales. Now for this sector, this growth rate, analysis suggests a fair ratio is probably closer to 2.7 times sales. That fourfold premium suggests the market is priced in not just aggressive growth, but decades of flawless execution, zero competitive setbacks, and immediate margin expansion. That's a scenario rarely achieved, especially in government contracting.
But that required future execution is precisely what major analysts are anticipating. The stock isn't trading on yesterday's 12 cents EPS. It's pricing in that substantial leap to the forecasted EPS next year, 78 cents. And maybe more importantly, the long-term projected EPS growth rate, that 30.41% over the next 5 years. The analysts who really understand the defense acquisition cycle, they seem to agree the average target price sits comfortably higher, around $99. This indicates a pretty strong conviction that the investments we discussed in unmanned systems and hypersonics, they're nearing an inflection point where they translate into exponential and, crucially, margin-accretive revenue.
Okay, I agree the consensus target price is high, but that takes us directly to the issue of cash flow and investment risk, because future earnings, well, they require present capital. We really need to question where the capital is coming from to sustain this 30% growth rate, especially given the company isn't actually generating free cash flow right now.
But the underlying investment strategy is, I believe, strategically sound and, frankly, necessary. The aggressive capital deployment, including that recently announced $50 million hypersonic system payload integration facility, it's a deliberate, required expenditure to secure long-term market dominance and, yes, higher margins down the road. We have to remember, Kratos is in the development phase of these highly specialized assets, and the balance sheet is robust enough to handle this, let's call it planned sacrifice. We see strong cash holdings, 3.35 cash per share, and that very low 0.07 debt-to-equity ratio confirms they aren't financing this growth recklessly. Management has explicitly said they anticipate Kratos will transition into a material multi-year cash generator after 2026-2027. So current negative cash flow isn't a failure. It's more like a planned, temporary cost of securing that technological leadership.
Though, have you considered the current operational reality that maybe threatens that 2026-2027 deadline? You see, management's anticipation relies on, well, perfect, seamless execution in converting that massive backlog into profit. But current metrics show an extremely tight operating margin, just 1.89%. And more worryingly, that 0.95% return on invested capital, it means that for every dollar Kratos invests in its business, R&D, people, new factories, it only gets back about a penny in profit. That's an efficiency rating that needs, well, radical improvement. And the reliance on negative free cash flow today to fund this growth, coupled with the exposure to supply chain constraints and labor shortages, things specifically mentioned in recent reports, significantly increases the execution risk. And remember, these are often fixed-price government contracts. If costs overrun, those already razor-thin margins could just disappear entirely.
Well, those operational headwinds, look, they are present across the defense industry. That's true. But Kratos has institutional support and, importantly, political alignment that I would argue actively mitigate that execution risk substantially. When supply chain issues hit, priority delivery status often goes to programs deemed critical to national defense. And that's precisely where Kratos' unmanned systems and hypersonics programs sit. And their low financial leverage, that's key here. It allows them flexibility during these kinds of ramp-up cost pressures.
Okay, Let's examine that support then, particularly the behavior of those, closest to the operations. Because I'm just not convinced by that line of reasoning when executive actions seem to fundamentally contradict the bullish sentiment you're describing. Insider ownership is strikingly low, just 2.05%. And maybe even more concerning is the consistent net insider selling, measured at negative 6.2%. We've seen numerous sales throughout 2025 by division presidents, the CFO, the general counsel, the very people who should be most confident about this 2026 cash generation timeline, and they're often selling at climbing prices. So are we supposed to believe the narrative about the bright future, or the actions insiders are taking with their own stock?
Sure, insider selling is a valid metric, definitely something to track. But I think it's offset by the overwhelming confidence shown by external, sophisticated capital. Institutional ownership is massive, 98.11%. That demonstrates real conviction from the largest, most experienced capital allocators, the ones who buy into the long-term vision and actually understand the defense industry's procurement cycles. They seem to be looking past these, perhaps transactional sales by insiders. Furthermore, the firm's deep, consistent relationship with its primary customer, the U.S. government, that's exceptionally strong and stable. You can see this reflected in their consistent quarterly lobbying expenditures, specifically tied to defense and budget appropriations. This political engagement, coupled with the proven DoD contract wins, it serves as a major de-risking factor for the revenue stream that arguably far outweighs individual insider transactions.
I agree the government is a reliable customer, yes, but the low ROIC and that thin operating margin suggests they might be a high volume but currently, unprofitable customer for Kratos. And this forces the company to finance expansion either through continuous capital raising or just internal cash drain rather than internally generated cash flow. The pattern of insider selling, to me, it suggests that those closest to the operations see the current stock price as maybe an opportune exit point, capitalizing on the institutional euphoria regardless of the strong balance sheet you mentioned.
Look, at the end of the day, the data clearly shows Kratos is a pure growth stock. It's trading on future defense spending priorities, on critical, cutting-edge technology platforms that are clearly moving from R&D towards deployment. The health of the balance sheet, the significant backlog growth, the strong market recognition, including its S&P Mid-Cap 400 Index inclusion, these collectively position it for dominance in the long term. And that, I argue, justifies the current investment phase and the significant premium. This is really a bet on the future defense landscape, and it's backed by substantial contract wins.
Complexity often requires multiple perspectives, doesn't it? And from my perspective, Kratos appears fundamentally overvalued. Its price seems built almost entirely on hope for flawless execution and massive cash generation after 2026, which is absolutely necessary to justify the extreme current valuation. But the harsh financial reality today shows suppressed profitability, negative free cash flow, and that sustained insider selling. If those future growth forecasts fall even slightly short, or if the ramp-up phase just takes longer than anticipated, the risk of a swift, significant correction remains, I think, very high.